Markets are crashing very badly, both Indian and US markets. Crude oil spiking. The Strait of Hormuz, a waterway barely 100 miles long, it is disrupting oil supplies to India, which is over 1,000 miles far away. Because of this geopolitical uncertainty, investors are getting nervous. For those who invested near the highs, this is a hard phase to sit through. But if you look at every major crash, from Lehman Brothers, COVID to Russia, Ukraine, markets have historically bounced back. Those who kept investing through the pain, history has been kinder to them. I stole that line from Manmohan Singh.
History will be kinder to me than the contemporary media.
Over the last few years, investing in US stocks from India has gone from only rich people do this to something your colleague is probably already doing. Platforms like IND Money and Vested have made it possible for anyone sitting in Bangalore or Hyderabad to buy tech stocks like Apple, Nvidia, Microsoft, Google directly. You pick the stocks. And when you look at the numbers of the market, it's hard to ignore. From 2019 to 2024, just 5 years, the Nasdaq 100 has delivered 26.4% CAGR. The Nifty 50 has delivered 19% in the same period. That's a 7.4% point gap. Every year compounded. And here is the part nobody talks about enough. The rupee has depreciated against the dollar for 30 years in one single direction over the long term. Most people see this as a problem. Smart investors see it as a free return. Every time you bring back your US gains home, the rupee depreciation adds to your return automatically. Your Nifty SIP doesn't give you that. But before you open an app and start buying Nvidia or other tech stocks, there is one thing most people never fully understand. What does it actually cost to move money from India to US and bring it back? Because this is not a Nifty SIP. There are bank charges, currency conversion fees, brokerage on both the sides, withdrawal cost. It adds up to your investments. My name is Raghunath. I am the founder of Ivory Tower Media. In this video, I'm going to walk you through investing in the US stock markets from India. What is the real cost breakdown with actual rupee numbers, 3 ways to invest in US stocks from India, and 4 tax rules you must know before you invest a single rupee abroad. One of the biggest questions people have when it comes to investing in US stocks from India is what are the actual costs involved? I will give you a realistic walkthrough of all the costs involved. Because if you're investing in the mutual funds in India, not much cost involved, right? You set up an SIP and leave, or you invest in index funds like Nifty, or max you pick some known stocks in India. But money moving abroad is a little different. There are platforms like IND Money and Vested, etc. allow people to invest directly from India. I'm going to take Vested Finance as an example throughout. It is not a sponsored video because I have been making videos for Vested for a very long time. Recently, I even made reels for their Instagram channel. I am picking Vested because I know the platform very well and it is just easier for me to explain. Okay, now let's say you invest 1 lakh rupees in US stock market from India. You pick Apple stocks for that amount and Apple gives you 12% returns that year. Simple, right? Here's what actually happens to that money. You send 1 lakh rupees from your Indian bank account, let's say HDFC bank account, to invest in US stocks through Vested. The first step is outward remittance, money going out of your Indian bank account. Your Indian bank will charge an outward remittance fee of about 1,000 rupees plus 18% GST, which is around 1,180 rupees. This will be charged before the money even leaves India. The second step is INR to US dollar conversion. Once you send money from your Indian bank account, the rupees are converted into US dollars and FX markup fee around 1.5% is applied, which comes around 1,480 rupees. The third step is buying the stocks. For example, when you buy an Apple stock, Vested charges 0.25% brokerage on that buy trade, which is about 243 rupees on this amount. Let's assume the stock delivered 12% return. The investment grows, right? Now you want to sell that stock and get the money back. The fourth step is selling the stock. When you sell the stock, again, there is another 0.25% brokerage charges, roughly which is 272 rupees. Now, these are all still in US dollars. The fifth step is to convert from USD back to INR. Another 1.5% FX rate applies here, which is 1,627 rupees. The final stage is withdrawing the funds to your Indian bank account. These are called withdrawal charges. Vested in the regular accounts charges $5 withdrawal fee, which is approximately 430 rupees. The total cost in this entire exercise is approximately 5,234 rupees. So even if the US stock delivers a 12% return on your 1 lakh investment, you would finally receive about 1 lakh 6,400 rupees. Now what does this mean? The stock gave you 12% returns, but after all the cross-border expenses, your actual return is 6.4%. The other 5.6% is gone in fees before the money even reaches your account. Now you got clarity on the cost involved. As per Vested report, the average total portfolio of retail investors is more than $2,500. Their HNIs is above $45,000. You might be getting a question by this time. Even though so many costs are involved, why are so many people investing in the US stock market from India? Here are 3 major reasons for this. Reason number 1, rupee depreciation works in your favor. The rupee has weakened against the dollar for 30 years. When you convert your US returns back to Indian rupees, the currency move adds to your gain structurally, and it is not by luck. Your Nifty SIP doesn't give you this kind of benefit. Reason number 2, you get exposure to companies that don't exist in India. Apple, Nvidia, Google, Microsoft, there is no Indian equivalent to these tech giants. If you believe the next decade belongs to AI, semiconductors, and global tech platforms, the Indian market simply doesn't let you bet on that. The US market does, because the major companies are listed in the stock markets. Indians are already aware of this. That is why if you look at this Vested report, around 70% of the investments are direct stocks. The third reason is genuine portfolio diversification. Your salary is in rupees. Your house is in India. Your PF and NPS are Indian assets. If India has had a bad decade, policy risk, currency crisis, or sector slowdown, your entire financial growth takes a hit. A portion of your investments in the US markets breaks that concentration. Now let's look at the actual comparison between India and the US. Most of you watching this are already aware of mutual funds or SIPs, right? Even in my survey, the majority are mutual fund SIPs. So I'm assuming you are also in the same category, or Nifty index funds, maybe a flexi cap. I'm not here to judge you. What you're doing is galat, right? I'm not an influencer to do that. What I'm trying to do is give you a clear picture of US stock market. But here is the number I want you to digest. Comparison between Nifty and Nasdaq. From October 2019 to September 2024, 5 years, the Nasdaq 100 delivered 26.4% CAGR in Indian rupee terms. The Nifty 50 delivered 19% in the same period. That's a 7.4% point gap, annualized over 5 years. Now, before you assume maybe Nasdaq just had a good 5 years or past performance, blah, 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 let me tell you why part of that gap has nothing to do with which companies are better. The Indian rupee has moved in one direction against dollar for 30 years. You can say all those flashy things like Indian rupee will crush dollar, we will become Vishwaguru, etc. But in reality, INR is going towards 100 rupees. Soon, it will hit a century. If you are investing in the US stock market, this works in your favor. Every time you convert your US return back to rupees, the depreciation of rupee adds to your return. Now, how will this actually help? I will give you an example. Currently, $1 is around 92 rupees. If the rupee was at 92 rupees per dollar when you invested and it is at 97 rupees when you exit, even if the stock didn't move, just flat, you made 5.4% just on currency. Now add the compounding effect. Over 5 years compounded, that adds up a lot. This is not a speculation. This is the structural reality of the Indian rupee. Now let's get to the hedge part. How the fuck do we invest in US stock market directly from India? Here are 3 ways to invest in US stock market. I will use Vested as an example, not just because I work with them. I think they're the only platform who are exclusive to giving global exposure to Indian investors, and they've been doing pretty good job over the years. The first method is direct stocks. You pick the company, Apple, Nvidia, Google, Tesla. You buy your favorite shares directly. You have full control and you have full concentration risk. You are making the bet on one company's performance. The second method is index funds or ETFs. Just like how you invest in the Nifty in India, instead of picking one company, you buy the entire index. One investment and you own a slice of top 100 or 500 US companies. Lower cost and automatic diversification. No stock picking required here. For most professionals just starting out, this is the smarter entry point. The third method is fractional shares. This is something we don't get in the Indian stock market. One share of Amazon or Nvidia can cost $160 to $200. If you convert that into Indian rupees, it is a lot. What if you don't want to put that much money into the stock market? You can invest a fraction of it. Just start with $1. Next time, if you want to add some more, you can add like $5, $10, $100, etc. Same return proportionally. This removes the high ticket size barrier completely. And all three options are available for Indians under the LRS route, Liberalized Remittance Scheme. You remit from your Indian bank account, it counts towards your $250,000 annual limit, and you invest in dollars from there. Now let's move to the next segment, which is taxes. How are US stocks taxed for Indians investing in them? I will explain 4 things you need to know about taxes. Before we get started, here is a disclaimer. Consult a professional CA for your personal tax computation. Don't blindly go with YouTubers like me. The first one is short-term capital gains tax. If you sell your US stocks within 24 months of buying them, that profit gets added to your total income and taxed at your tax slab. If you are in 30% bracket, that's what you pay, 30%. The second is long-term capital gains tax. This has changed in budget 2024. If you hold your US stocks for more than 24 months, it is considered as long-term. Post-budget 2024, long-term capital gains on foreign stocks is now 12.5% flat. No indexation benefits. Take Priya, for example, a product manager in Bangalore. Her annual salary is 22 lakhs. Why 22 lakhs? Because Priya is rich and she did 10x AI course. Okay, Priya buys Nvidia stocks in January 2025, but just 9 months later, she sells that stock and makes a profit of 1 lakh rupees. That 1 lakh rupees gets added to her 22 lakh salary. Now, the taxable income becomes 23 lakhs. Because Priya sold it within 24 months period, this comes under short-term capital gains tax. If you look at the tax slab as per Nirmala Amma's new regime, her 23 lakhs will fall under 20 to 24 lakh slab. That tax will be 25%. She has earned 1 lakh profit and she will pay 25% of that gain, which is 25,000. Now, if Priya had kept the stock for more than 24 months, it will become long-term capital gains. Long-term capital gains tax is 12.5% flat of 1 lakh rupees, which comes to 12,500. Same stock, same returns, just the taxes are different because of the holding period. The second thing is US estate tax. What is estate tax? It's not like some real estate tax. In this context, let's say Priya, the rich lady who has US stocks directly like Apple, Nvidia, Google, etc. and something happens to her, she dies in Guntur eating spicy chilies. If Priya's stocks are worth more than $60,000, then the US government can hunt Priya's family and apply up to 40% estate tax. That is the IRS rule. If Priya is alive, then there is no tax. Next, let's look at the mandatory compliance. First is Schedule FA. Every year when you file your ITR, you must declare that you own US stocks, even if you didn't sell anything, even if you made zero profit. Just holding Apple or Nvidia or any other stocks, you must declare it. If you skip this, Nirmala Amma will come after you. They will come after you anyway. The second is Form 67. If any US company paid you in dividends, America already cuts 25% as tax before the money even reaches India. Form 67 is how you tell the Indian government, Inge Parama, I have already paid tax in America, don't charge me again. But first, you must file Form 67, then start the ITR process, otherwise you will lose the credits and you end up paying tax twice on the same money. So that's about investing in the US stock market from India. Let me know if you have some thoughts in the comments below, and I will see you in the next video.